Is the rental market set to soar, or is it simply hovering over a cliff ready to fall? I recently got this interesting report from Roofstock. They are a real estate investment platform that's really geared towards people who want to invest in occupied single-family residences as an investment, so you're inheriting a tenant when you buy the property. They look like a pretty good platform. I've never actually bought on Roofstock myself. However, I have browsed on their site before, and I also get their newsletters, which often have some pretty helpful information, and that's where I'm getting this report from. This article was called Vacancy Traits, and the subtitle was Vacancy Rates Are Dropping, but investors shouldn't get complacent. Well, let's dig into the numbers and see what they mean. The first chart that I really want to dig into here is this chart from the Federal Reserve. This is public information. You can go search the Federal Reserve's website yourself, and you can actually find all sorts of interesting data. But this specific statistic is rental vacancy in the United States, and it looks at the actual rental housing supply and sees how much is actually occupied. The higher this number, the more vacant rental units there are, which would probably mean that there'd be more downward pressure on rent, or at least less upward pressure because there's more competition with all the open units. Conversely, the lower this number, that would mean that there are less units available compared to the broader supply, which would mean that there'd be more competition between renters searching for a smaller supply of actual rental units. This would either cause rents to rise more quickly than they would otherwise, or they might actually prevent them from falling as quickly as they might if there were more vacant units available. Anyways, let's take a closer look at this graph and look at some of the history. If we go back to the early 2000s, we see at the end of the tech bubble, we had a recession in the US, and this was followed by a noticeable spike in the rental vacancy rate. So there were more vacant units relative to the broader supply of housing units. Recessions are marked by a gray bar. So theoretically, once the gray bar is done, that would mean that the recession is no longer happening and you're into the recovery phase. What's interesting is after the recession ended and we entered a recovery phase, which led into the housing bubble in the mid to late 2000s, notice how the vacancy rate actually kept going up quite a bit, well over 10% at some points, and usually hovered around that 9.5% to 10% rate up until 2008 when the actual crash happened, the Great Financial Crisis, which caused many things to fall, housing definitely included, since the housing bubble was one of the chief drivers of the global financial crisis. But you might think, wait a second, if things were really going well before the crash of 2008, wouldn't you expect vacancy rates to actually go down and thus rents and prices to go up during the otherwise hot times? Well, perhaps, but keep in mind that during the housing crisis, there was a lot of overbuying, in that people were buying units that otherwise could be used as rentals, but instead were keeping them vacant, just waiting on appreciation, betting on the market to keep carrying prices up and up and up, until eventually, obviously, that trend can't continue. And many people were successful doing this for some time, but obviously that trend can't continue forever. You got to have rental income holding up the weight of some of these expenses. People were over-leveraging themselves out of their ears, and this was on a pretty broad scale. It wasn't just a few bad eggs. It was many different people were putting themselves in a very bad position. You can blame whoever you want to blame, but the fact of the matter is there was a lot of overbuying, driven in large part by bad credit and bad loans to people who otherwise shouldn't have actually been qualifying for them, but banks were getting greedy. There was pretty tight margins across the board, and you end up with the housing bubble that led to the spectacular crash in 2008. And during that time leading up to the crash, there was a lot of building going on, so you had a lot of new units coming into supply as well, which didn't necessarily have the renters to fill them. So that would probably also contribute pretty significantly to this higher vacancy rate during the mid to late 2000s. So 11% of the housing supply was vacant during this time. That is a massive portion of the market. Compare that to now, where we're sitting at about 6% vacancy with the housing supply. And we can see that there was a significant downwards trend in the vacancy rate as we moved towards 2020. And what's interesting is when we had our flash crash, if you can call it that, the recession that hit us starting back in March of 2020, you notice that what actually did not happen compared to the last few recessions is the fact that rental vacancy actually went down. It did not go up, which is what happened in the previous crashes. And it went significantly downwards from about 6.5%, 6.75%, all the way down to under 6% vacancy rate for the rental housing supply in a very short period of time. Now you might ask, why did that happen? And there are many different factors to potentially point to, one of them being the eviction moratoriums that swept across the nation because you had all the economic hardship caused caused by the lockdowns and the virus and the pandemic, all the bad things associated with that, governments decided to just try and hit the pause button. You see some of the lingering effects now in that many of these moratoriums that started way back in March, April, and May of last year are still continuing even now, and some are being extended through the end of the year. So you have lots of different things that are still yet to be seen what the exact consequences are going to be, but that certainly was a short-term consequence in that the vacancy rate for rental housing actually went down even during a recession. So the question is that only temporary? Will we see a spike in rental vacancy once the eviction moratorium ends? I think in all likelihood, yes, we will see some sort of move upwards since you have lots of new rental housing supply that will come online, at least one way or another, where landlords would otherwise be unable to evict a tenant who would have otherwise been evicted in a quote-unquote normal time. But it's unclear how many of those units are actually out there. And that's with the added wrinkle of the fact that there's tons, billions of dollars of rental assistance coming in to try and weather the coming storm of the eviction moratorium ending. So you might have a lot of people who might otherwise be evicted again in a quote-unquote normal time, but they're getting a ton of money from the government to then pay back rent. So everyone just gets back to square one and we don't have any evictions. And that's the whole goal of these programs. Of course, that just means that all Americans are paying for it via added national debt, inflation, all those good things. But that's kind of the situation we're looking at with the housing market. And to get some sort of ballpark, we can look at what Roofstock said, pulling from a Zillow report. They said that in March, 8.4 million renters said that they were behind on their rent. This is March 2021. And 1.41 million said they believe they were very likely to be evicted when the eviction lockdowns ended. And then in June, there were only 7.1 million renters who reported being behind on rent. So over a 12% decrease or so in the actual amount of people who said they were behind on rent. This is obviously self-reporting, so who knows how truly accurate it is, but it's probably pretty close. And 1.2 million said that they were likely to be evicted. So that number has also decreased by a good amount. And this is, again, self-reporting, pulling from a Zillow report. So if that's some sort of proxy for what's going on, you might see this trend continue as more of the rental assistance programs make their way through the country, both at the federal and state levels. And that would probably push both of these numbers down since you just have more money floating around in the system. But you know what else that might mean is that rental rates will probably be going up too, since you're basically boosting the incomes of all renters out there. And when you boost everyone's incomes, well, all of a sudden, each renter becomes comparatively more competitive than they were before. And if renters are more competitive and chasing the same rental supply as before, then you're probably going to see rents rise in some way, at least in areas where they can rise and they're not restricted by things like rent control, which would cause other discrepancies in the market. Now, on a related note, let's take a look at this report by HUD, which looks at new residential construction. And they're looking at housing starts and general housing building starts. This is everything from single family up to 5 units and beyond. So you're looking at what sort of development we're seeing in the housing market, which would apply to the rental housing market as well. Since if there's more new supply online, you'd expect the vacancy rate to also go up since you're going to have the same amount of renters as before, but you're going to have more supply. So thus, your vacancy rate would go up. And we can see that housing construction is up from last year. But back in 2020, we did see a substantial dip for quite some time, partly because of supply shutdowns, just lots of uncertainty in the market. A lot of lending stopped for a brief time period in actually starting new homes. Since real estate is a very debt-reliant industry, so when there was a lot of uncertainty and a lot of credit freezes, at least for a very short period of time, you saw a massive dip in new residential construction for the time being, but that seems to be being made up in 2021 now that things are back to normal, or really not even normal. We're just back into a frenzy of housing demand. That demand in large part being driven by much cheaper dollars compared to last year. So what can we make of all of this? What is going to happen to the rental market? Of course, no one actually knows. This isn't financial advice by any means because I don't have a crystal ball. I can't tell you what will happen. But let's go ahead and make some educated guesses based on the data that we know. We know that vacancy rates are already quite low. We also know that there's tons of money swimming around the system looking to find a place. A lot of rental assistance has not made its way into renters' pockets and thus into landlords' pockets as well after rent is paid or any back rent that is owed. We know there are a lot of supply bottlenecks with building new housing right now, and that's making that more expensive and thus harder to do, even though housing construction is picking up compared to last year. It's still not ludicrously higher, and it would still take some time to actually get those new units online and ready to go. Construction is a very long process. But once the eviction moratoriums end, which might take quite a while since the government is really good at kicking the can down the road, but once those do end and you see a lot of the rental assistance actually make its way through the system, I wouldn't be surprised if we see the vacancy rate remain relatively stagnant or even decrease because of how much new money is in the system. It's very hard to tell how many evictions are actually primed to happen once we get to that point. Or at least once you see bargaining power shift back towards landlords in that respect, where the threat of eviction is there again if someone stops paying rent for whatever reason, whether maliciously or not. It is the way the system has historically worked. But I wouldn't be surprised if you see a very short-term spike upwards in the vacancy rate once the moratoriums end, assuming they all end around the same time, the federal one and then all the state ones that are still going on. We'll see what happens there. There might be a short-term spike followed by maybe a more moderate decline back down to some steady rate, maybe around that 6% rate we've been at for a little while now. But this is definitely something to keep your eye on, especially if you're looking to invest in real estate, since the supply and demand characteristics are going to determine how many opportunities are out there in many cases. Of course, you can always come across great deals, even in otherwise quote-unquote bad markets. Everything is relative, and every piece of real estate is unique, and you don't know what source of value you can create with a particular deal until you look at it. But if you can find a place where vacancy rates are relatively low compared to another market, that could be a place to start if you're looking at long-term growth characteristics and maybe a better market to get into if you're looking for long-term growth and a safe rental market, or relatively safe. And if we do see a spike in the vacancy rate, that might be a signal that you might have some more opportunities coming in the near future, so you'd want to be ready for those in some way. But of course, there are always opportunities to look for in any market, whether it be a hot or cold one. Usually what changes is the means to get those opportunities, and that debt will dry up in an otherwise down market, even though there will be more opportunities out there that look really good on paper. Whereas in a hot market, credit and debt is very easy to come by, so you can get into deals easier, but the deals are more expensive because the same holds true for basically everyone. Just remember, as a real estate investor, you're investing in deals, not markets. And yes, the market can affect how many deals are out there, but ultimately it comes down to the individual deal to determine whether it is a good investment. Anyways, if you guys found this informative, definitely leave a like, since that would help the channel out a lot. And if you like this sort of content about real estate, the markets, and pretty much everything as it has to do with personal finance, definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out some of the free stuff from the affiliate links in the description below. But until next time, take care.